afternoon, ladies and gentlemen, and I'd like to welcome you to this Infrastructure Africa Plenary Panel 3. My name is Duncan Bonnet. I'm a director of a company here in South Africa called Africa House. We're a research and consulting company focused on Africa. The topic we're going to be discussing with our panel today, and we've got a great panel to talk you through it, is boosting capital for development and new approaches to financing Africa's infrastructure development, infrastructure funding and finance mechanisms. To talk you through this, I'm going to go through the panel in no particular order, just the way I've got it in my notes. So first of all, Paul Mojalefa, who is the deal originator at the Export Credit Insurance Corporation, has 22 years experience in financial modeling, project finance, public-private partnerships, debt capital markets, telecoms finance, and ECAs. Prior to joining ECIC, Paul had worked numerous projects for Africa Rising Capital, including instances of hydropower projects in Zambia and Malawi, cement project in Malawi, agricultural milling projects in the Northern Cape, and quite a wide variety of others, including fiber optic projects. So Paul, I think, brings with him a wealth of experience across a range of sectors. The next person I'd like to introduce to you is Micah Wetch. Micah is the unit head of capital raising and funding finance at the Kucha Development Corporation. And she holds an MSc in economics, specializing in global finance. She produced extensive economic forecasts supporting the development of local value chains relating to oil and gas, nuclear and renewable energy, and continues to work on the financing of energy projects, including the LNG importation infrastructure in the port of Ngqura here in South Africa. And I think very, very topical given the energy requirements both in South Africa and the region. Next, I'm going to get to Sam Mokorosi, is the head of deals and origination at the Johannesburg Stock Exchange here in South Africa, seasoned financial services executive with almost 20 years experience in corporate finance, private equity, and the bond market. Successfully executed corporate finance and worked to the worth about 40 billion Rand. He has worked at Standard Bank, Cadis Corporate Solutions, Quartile Capital, and Vunani Capital. So bringing with him that corporate background into the finance sector. Just going to skip to Stephen Gray, who is with UK Export Finance, the regional representative for West Africa, based in Ghana, and an accomplished senior manager with in excess of 30 years, including multinational roles, spanning challenging societal and economic environments across Africa and the Middle East, with the trading, logistics, construction, infrastructure, and mining sectors. And as the UK Export Finance representative in West Africa, Stephen is responsible for originating a pipeline of new opportunities across the West African sub-region. So bringing with him both the global and the regional expertise into the room, and obviously being based in West Africa brings a perspective outside of a South African one for us. Lungile Tom, who is currently a senior investment officer at the Development Bank of Southern Africa, the DBSA, here in South Africa, specifically focused on project finance, infrastructure projects across various infrastructure sectors in South Africa and the rest of the African continent. Lungile is an experienced financial investment professional with over 10 years of transaction experience in that as a chartered accountant and a Harvard South African fellow as well. So Lungile brings that development finance experience from South Africa and into the rest of Southern Africa and Sub-Saharan Africa, and I think the whole of Africa these days from the DBSA's perspective with an increased mandate. And it's great to have you as well, Lungile. And then finally, last but certainly not least, we have Hannah Kamwanga, who is the country officer in the Democratic Republic of Congo, the DRC, for Proparco, the French DFI, which is one of the world's largest and leading development finance institutions She is an investment committee member of Launch Africa, which is the first Pan-African early stage investment fund, as well as Arua Capital, a leading gender lens Nigerian private equity fund, and a board member of the African Business Angel Network, which is a Pan-African nonprofit association. Hannah also is a co-founder of two top investment clubs in Africa, Dazzle Angels, looking at, it's the first woman-led fund looking at female-led tech businesses, and DIA, the first DRC impact investment club in the country. So bringing both a background rich in the development finance as well as launching into private spaces, and including, very importantly, I think, in Africa, as in other parts of the world, that gender lens with her. So thank you, all of you, for being here, and welcome to the session. I think it's going to be a great session. And as I said, I'd like to kick off and ask each one of you, just in a couple of minutes, the first question people talk about when they talk about projects and financing in Africa is, some people say there's a shortage of projects. Others say there's a shortage of finance, whilst there's a sort of a middle ground which says there's quite a lot of both, but perhaps the projects aren't packaged attractively enough to enjoy that finance. So perhaps we can start, Paul, with you as Export Credit Insurance Corporation, and then we can move on to the other participants, just to get your initial assessment of, is that a correct perception?
Thank you, Duncan, for the opportunity. Yes, I say that from our experience at ECIC, there is no shortage of projects, and there certainly is no project of financing. However, the issue we see is that the projects are not well packaged to be a bankable form, and that is why the pipeline of the projects we see, many of them take many years to get to fruition. So from our perspective, the projects are plenty, the financing is plenty. However, many of those projects are not at bankable stage, which then frustrates their progress to go forward quickly.
Lungile, from the perspective of the DBSA?
Thanks, Duncan, and for opening up with that question, which is quite relevant to the rest of the continent. I share the sentiments that my colleague Paul has conveyed in terms of saying that there are no shortages. I think the biggest issue, or rather problem, that a lot of the projects are facing in terms of getting them off the ground is certainly bankability. And what that means primarily is, a lot of them require some form of credit enhancements just to improve the bankability of those projects, and also catalyze the involvement of other lenders into those projects. And often what we find is that some of these projects are backed by governments that are not strong enough, so that the off-taker or the underpin of that project may be a government that's not particularly strong from a risk rating perspective. And so there's a lot of massaging and, structuring that needs to take place in order to improve the bankability of that project. And what we find is that you have to structure in some credit enhancements that don't really rely specifically on the underpin of that particular government. And what we often find is that some of these projects also need some form of concessionality that is blended in with commercial funding as well, just so that it absorbs or allows a more affordable cost of funding for those projects in order for them to move forward and be able to be bankable and fully funded at the end of the day. Thanks.
Thank you very much. Stephen, if we could jump across to West Africa, it's a very intriguing region in Africa. There's a there's a number of fantastic countries and opportunities there. But we also hear from quite a few of our colleagues that sometimes projects are not that easy to get off the ground. What's your perspective?
I think it's a similar experience across the whole continent, to be perfectly honest. And we go to repeated conferences and we talk about this problem all the time. There is no shortage of projects and there is no shortage of capital. What there is a shortage of a risk mitigant for time consistency risk for investors to package projects to a bankable standard. And so that's why we often see a lack of credible project sponsors structuring projects, but where they are credible is because they understand the markets deeply. They have very strong relationships to be able to manage that time consistency risk. Often you then see other sponsors who have good relationships in markets, but don't have the depth behind them to be able to fund fully the project preparation stage of projects to make them bankable. And yes, there is a range of project preparation funds out there. You know, you've got InfraVentures from the IFC, AFDB have got a window for this. But all too often, their expectations of being able to come in and offer funding for the project preparation phase is on too short a time horizon to get those projects fully funded before they're looking for a return on the funding that they offer for PPFs. So if we're going to move the dial on delivering out and building more infrastructure projects in Africa, we have to deal with this problem of project preparation, time consistency risk, and bringing in credible capital that has the depth and the strength to give us financiers comfort to take a project through completion risk to commercial closure and to the sort of longer consistent delivery of those services the infrastructure is delivering.
Perfect. Hannah, I'd like to ask you from the perspective of Proparco and somebody sitting in the DRC, which probably has amongst the highest needs in terms of infrastructure financing and delivery.
Exactly. I think DRC is a typical example of the African country where the needs for infrastructure, whether it's transport infrastructure, roads, airports, ports, railway, whether it's energy infrastructure or telecommunication infrastructure, those needs are real, but there is a lack of common ongoing response and answer to meet those needs. And I completely agree with the rest of the panelists. There is a cocktail of misalignment and issues all over the project financing cycles that explain that we are still in a situation where projects cannot be supported. And I will just highlight a few of those, starting unfortunately by the sort of governmental and public aspect of things. So Longule has highlighted that some African governments don't have the creditworthiness to support some of those infrastructure projects. On top of that, if you are in a country where the regulatory and legal framework is perceived as uncertain, or for instance, concession agreements, are they really exclusive? How do the tariffs work? Will the government overnight decide that you have to sell your electricity for 1 cent instead of 20 cents? So when you have a public environment where there is a high level of uncertainty, it's very difficult for both operators and funders to actually fund infrastructure projects. Then I also agree with the issues we face when it comes to project preparation, especially in a country like DRC. Sponsors, promoters don't have very often the financial and or the intellectual or track record to design infrastructure projects. But I guess we are starting to see some answers, and I will comment on that. The last 2 points that I want to highlight are also the fact that credit enhancements tools are also missing. So for a country like DRC, a lot of guarantee schemes that are available in other African countries are not available in our country for many reasons, but which also explains why those infrastructure projects are not financed. And the last point that I want to highlight, and I think as part of the DFI community, like the development finance communities, we need to be aware of our sort of responsibility. There is often a misalignment between, DFIs and funders when it comes to risk appetite, structuring, return expectations, which means that funding processes are much longer and or will not happen.
Perfect. Thank you very much, Hannah. Micah, you, from your perspective, having looked at the value chains around oil, gas, that kind of infrastructure, where do you see that?
Look, these days I spend a lot of time raising finance for projects, not only here at Kucha, but also on the African continent. And I want to agree with the thing. There's enough money available, but the point is, it's the private sector investment is not coming to Africa. It's going to other developing countries, but it's not coming to Africa. And there's a series of reasons for that. And the first one is the political risk associated with especially large infrastructure projects. We seldom see meaningful commitment mechanisms that protects projects from a political holdup of revenue streams. And that's a massive investment risk, and we're not having the conversation around that. And as much as you can engage in political risk insurance, that particular commitment mechanism you can really only properly achieve with multilateral institutions that has the ability to intervene on the host government level. So that being the first one. The second one is in terms of often how the projects are structured. Many of these projects are very small and they don't justify the costs that would want to have to incur to put proper finance mechanisms in place. There's a lack of standardization, there's idiosyncrasy in markets, transaction costs, information asymmetry is very expensive to work with. And the only way that you can overcome that is through standardization of, for example, contractual mechanisms across the continent. And also, in terms of bundling projects. And this speaks to the risk of the project itself. What we find is that often when you're trying to finance African infrastructure projects, and let me use energy as an example, the risk at different phases of projects vary substantially. So when you're in construction stage, you're looking at large committed funds. And that's the kind of funding that you would, this is sunk costs, these huge risks do that. So you typically would want to use, public sources of finance, multilateral sources of finance. And at that point, there's the risk in terms of project preparation. You can use both public and possibly venture finance to finance project preparation. But the moment that utility starts operating, it becomes a nice boring asset for a pension fund. And to the extent that you can secure the revenue streams for that project, now the risk rating changes completely. And when we start unbundling the risks and start financing on that basis, you then start differentiating almost on what that asset is at different stages. And you can then start putting in sources of finance that you otherwise wouldn't be. Another thing that you could also do is once you've unbundled it, you can rebundle them. And there you can aggregate risks across countries and across projects, and that further lowers. So a bit of imagination there to be required, to apply to this. But if you sort of take a macro view on this, I think one of the things that we need to realize is that this is market failure, both in terms of private and public markets. A last comment that I want to make is that often when you're dealing with infrastructure projects on the continent, and this is very specific to our continent, is the combination of what you need to develop projects is not only a deep technical skill set, and there's already progress being made in supporting governments and projects to develop projects and package them properly and so on. But the thing that we're missing is to get a project happening in Africa, you also need a very specific high level, what I will call political entrepreneurship. because the way our governments work in Africa introduces several veto points. And to coordinate that and to move an infrastructure project through those approvals and through that consensus is a very specific skill set. And what we need to do is we need to look at business models on how you can combine that technical project preparation with that political entrepreneurship so that you don't have these incredibly long approval timelines, delays, and so on, because the longer that timeline becomes, the more risky the finance becomes, the more expensive it becomes. And if you push a project beyond a certain timeline, financial models tend to collapse. So there's certainly things that we can do to solve, but I think we need to be very honest in terms of the kind of problems that we face on the continent and have a discussion around how we can solve that.
Perfect. Thanks very much, Micah. Sam, I saw you nodding vigorously at a lot of those points from a deals and origination perspective at the stock exchange. How do you see this?
Thanks, Duncan. So we look at this, we see this in kind of two different angles. So sometimes project promoters will come to the exchange saying, I need to raise $1 billion for a project. Can I list my project? Can I list my project company? And then through our recently launched JSE private placements, we're seeing unlisted project and unlisted project developers come through to us. So I certainly agree with the sense that that other panel members have mentioned around that projects are there, money is there, but there's a mismatch. And in my mind, that mismatch is in that early stage. And just to think about it, if it's $1 billion infrastructure project, your project prep funding can be anywhere between 1% and 5% of that project. And we're talking there about, $10 to $50 million. And that's where often this falls flat. Stephen mentioned that there are some project prep funds available in the market, but often those project prep funds will not fund the entire project prep life cycle from kind of concept to bankable feasibility. So if you're raising $10 million for project prep, maybe somebody will kindly fund you for $5 million, but that other $5 million high risk money is really what we're missing. So I guess in conclusion, my answer to the question is there is a lack of money, and the lack of money is in that high risk early stage when projects are being developed. Totally agree with both Hannah and Micah around also kind of regulatory and government approvals and delays that often put projects in jeopardy, again, in that early stage, and therefore increasing the risk in the early stage part of the project, and thus chasing away capital in that early stage of the project cycle. So that's my view. Thanks, Duncan.
Brilliant. Thank you very much, Sam. So I think the next thing then is we kind of understand where the bottlenecks are in the delivery of a project from conception to construction. How do we overcome this? I mean, are there innovative finance models that are starting to emerge that overcome this? Are we starting to see that we're moving into a new financial modeling around projects in Africa, and perhaps without wanting to put people on the spot and giving away project details, maybe a couple of examples of where innovative project funding has unlocked what was previously or a particularly difficult project, or maybe a new one that's emerged. Lungile, maybe you want to kick us off on this one from the DBSA side, and just, are we starting to reimagine project finance?
Well, thanks, Duncan. I think what maybe a lot of sponsors are not aware of is that, there's a lot of pockets of concessional funding by quite a number of international organizations that really offer, niche funding to specific sectors to address specific needs in those respective sectors at a concessional level. And what often happens is that DFIs have access to some of these funds, and programs can be designed alongside these organizations and the funds available from those organizations in order to provide a solution to that respective sector. For example, you have funds like the Green Climate Fund, for instance, out of South Korea, that primarily focuses on renewable energy investments or adaptation and mitigation projects in various sectors. So DFIs have access to these. There's specific requirements they would need to comply with, and they can partner with such organizations. DFIs, I include DBSA as well, to provide a solution that is affordable to the project, to allow the project to move forward, but also allow that DFI to take some level of risk as well at an affordable rate. That risk can come in the form of a first loss facility within that respective project, just so that it alleviates the pressure that is required from a senior debt funding perspective. And obviously, it's not precluding that DFI from participating in the senior facilities or debt that would exist in that project, but also just to increase the first loss layer that would give more comfort to senior lenders and let senior lenders participate and have greater access to cash flows for their purposes of servicing whatever facilities that they would provide in that project. So I think looking at sources of funding that will allow us to blend whatever we have, just to reduce the cost of funding, I would say, to those infrastructure projects, and really allow them to improve the bankability as well, and also DFIs taking also riskier positions in the form of the first loss facility that I mentioned now, just to catalyze the participation of other lenders in there. I would say that's probably one that, an example that I've seen play out, especially with the partnerships that we have with various organizations that provide niche concessional funding in various sectors. Thanks.
Thanks, Lungile. Hannah, I'm going to come to you, because whilst Lungile was talking, I kind of took me back to a project that I worked on in the DRC a number of years ago. It was a new cement plant that was being proposed in the west of the country, outside of Kinshasa. And I think there were 14 or 15 different banks and DFIs involved. One of the issues was that when we submitted the report, some of those financial institutions had never set foot in Africa, never mind understanding the complexities of the DR Congo. How do you as Proparco kind of deal with that, or try to overcome that within the context of sort of unlocking a more innovative funding?
Yeah, exactly. I think it's a very relevant comment, Duncan, and I'm not as optimistic as my fellow panelists Lungile when it comes to, for instance, the availability of concessional funds when it comes to a country like DRC. DRC, I would say, is a frontier market of the frontier markets, and even when we talk about Africa, Egypt or Nigeria have nothing to do with DRC, and it's a level of organizational and geographical complexities that a lot of DFIs and investors cannot really understand when it comes to a country like that. You've mentioned that DRC in itself is already a very complex country where you have to deal with a political and legal framework which is very complex, with a population that does not necessarily have the purchasing power to support any type of infrastructure projects, whether it's a reality or perception, because we're starting to see, for instance, in the energy sector, more mini grids or mini hydro power plants being built in the central and eastern part of the country. And actually, the population has a power to pay. We see more and more businesses like miners or SMEs in the agri sector willing to sign offtake agreements even for 1 year or 2 years, or willing to sign LOI saying that we'll buy electricity. So we see some changes. Nevertheless, these positive trends in the market are still anecdotal, and it's very difficult to convey what is happening on the ground internally to our credit committee, investment committees, and to other DFIs who have never set foot in DRC Congo or in Africa. Yeah, I think it's so slowly. I think we'll find the winning solution, but. And also, if I bounce back to Longile's comment when we talk about, you mentioned 14 or 15 financial institutions. So it means that as an institution, you not only have to deal with handling a complex project in a complex country, you also have to deal with complexity internally, because DRC is perceived as a higher risk country, which requires to go through more committees than if you were, let's say, in Egypt or in South Africa. And then you have to deal with a consortium that is probably bigger than in any other country, because each institution is like, DRC is risky, so we'll not put more than 10 or 20 or $30 million. I think from my perspective, it would be a question of, finding the right case study in each, infrastructure segment, like in the renewable energy sector or the transport sector. And hopefully it's a case study that we would be able to replicate. So by the way, I'm more than happy to discuss with some of my fellow panelists of the record, if any of them are actually investing in DRC, and to try to see in a few opportunities how we can work together. And I'm pleased to confirm that I have actually spoken already with some of Lungile colleagues at DBSA literally 2 weeks ago, and we are trying to see in 5 or 6 projects in energy, telecommunication, and also with transport, how we can make the structure work. That is challenging.
Brilliant, thank you, Hannah. Stephen, in terms of innovative funding, one of the things that quite often comes up is can DFIs compete with Chinese finance? I don't know if you agree with that sentiment, and if so, what kind of innovations, so that there is more than one source of infrastructure project finance out there, can we start to look at, and what are your experiences in West Africa?
Yeah, so I think the Chinese question, we have to burst this bubble. In November last year at FOCAC, China articulated their financing to Africa for the coming 3 years. And I think it was very notable that, the amount of funding available was reduced from 60 billion to 40 billion, that they were no longer doing direct lending to governments, and that the 40 billion left, 10 billion was to support Chinese companies to invest into the continent, 10 billion was to support trade finance from Africa back to China. 10 billion was SDR allocation to be lent to African countries to help their fiscal position. And the final 10 billion was to be invested into financial institutions. So, in competing with China is not a feature, to be perfectly honest nowadays. China will invariably channel some of their funds through DFIs, so that they have a seat at the table to get visibility on the opportunities, but they're not on the front firing line today in the way that we've seen them in the past. So, the challenge, I would say, for the DFIs is actually to fulfill their mandates. You often see DFIs actually competing with commercial banks for transactions and not necessarily taking the development risks that they were set up to do in the first place. And I think when you talk about innovation in financing, it's not going to come from the banks. It's coming from the risk takers. It's from the export credit agencies. It's from the political risk insurers. It's from those that are prepared to take risks. As UK Export Finance, we're there for credit risk, and we bring in the risk mitigants for that. For political risk, clearly there's MIGA and various other multilateral institutions. Market risks, some market risks, investors will take that risk. And so that's the area that really we're seeing the innovation coming in. You see people like African Trade Insurance Agency, again, another multilateral institution providing credit risk for both public and private sector across the continents. But because they have preferred creditor status, it's bringing in the London credit risk insurance market into Africa in a way that wasn't possible in the past. So that's where I see the innovation happening. It's in these risk mitigant products, first loss, as Lalumi said, and others. And that's where we need to see the focus. Talking earlier about lack of capital for project preparation, there's a lack of risk mitigants in project preparation. There's capital to go there if the risks could be mitigated. And I agree that political entrepreneurship is a key skill, but time consistency risk mitigation is available there. And so if you look at MIGA, if you're investing in project preparation at equity, they have equity political risk cover that could be utilized for a project preparation stage if it was equity funding that.
Great, thanks, Stephen. Paul,
sorry to bounce back on that, but representing or talking about frontier markets, MIGA and all these type of insurance schemes are very expensive. So a lot of operators are actually not able to afford them, which is another example of how this type of solution that can be relevant in more advanced African economies are unfortunately not suitable for frontier markets.
So, Duncan, I just come back to Hannah on that. I agree with you, those risk mitigants are expensive. And this is another area where I think more work has to be done on the continent because the cost of risk is a measured number. And all too often in Africa, we don't have sufficient data to measure the risks accurately. And so often people are making decisions based on perceptions rather than reality. And so I think another area of innovation that is important, that's probably overlooked, is access to data so that risk companies can measure the reality of the risks rather than the perception of the risks. And again, DFIs, I think, should be doing more in that space, like the World Bank did in the early days in terms of thought leadership around force ownership models and the energy sector, BPA.
I completely agree in terms of the level of data that's available to make these kinds of decisions. I think we see it on a daily basis where companies, whether they are looking simply to trade into the continent or if they're looking to invest in a small or a large project, are faced with gaping gaps in their data and the analysis. And quite often I find also the modeling of that data tends to not sometimes reflect the realities in Africa, but the realities in parts of the world where that modeling works, which isn't necessarily here. Paul, I'd like to bring you in on that as an export credit agency in terms of, where does the balance of risk lie in terms of unlocking that funding?
So as ECIC, we provide insurance cover to financial institutions, South African registered lenders, who finance these projects on the back of South African exports. In other words, you would have a country like Tanzania, for example, who would have a South African bank financing an infrastructure project there, meaning that now you're taking South African government rating into Tanzania. In that way, the lender in South Africa would then be able to benefit from from pricing it competitively into that market with an ECIC cover behind them. Our cover, one would be political risk insurance, and two, commercial risk insurance if it's in the private sector or PPP and so on. So we actively seek those transactions going forward, especially where we know they will be game changers, like power projects, like energy projects, and even in some instances, universities and so on, where we know that having that intellectual capital helps also to fast track this infrastructure development. So we seek to find those projects that we know are game changers in some of the countries and in the region for that matter, on the export credit side, as well as on the investment side. We assist South African investors who invest in some of these infrastructure projects, which are aimed at lessening the gap that the AFDB and the World Bank and others have cited that needs to be plugged in the years to come.
Thanks, Paul. I think that does speak to the heart of the problem. One thing that I'd like to get onto as part of this whole risk mitigation, and that's the fact that so much of the borrowing in Africa is in foreign currency, which always does play a role. Sam, I'd like you to kick this off, and then maybe Micah, you can bounce back on it in terms of how do we build robust capital markets in Africa and be able to sort of meet at least part of the infrastructure needs of our projects, where we would be able to increase the level of domestic borrowing in domestic currencies to offset some of foreign capital.
That's a great point, Duncan. What we see across the capital markets environment on the rest of the continent is that there is a level of savings, at least in the pension space, and often the largest pool of capital sits with the government employees pension fund of that particular country. And what we see is that most of that funding is then reinvested in government bonds. And we've been working with various other organizations, including organizations representing various capital markets entities across the continent, to say, how do we introduce new products? How do we introduce new capital flows across that? So, that might be infrastructure bonds across the continent, or even just like we see in the South African context, where our SOEs, at least in the past, were quite strong participants in the bond market, and that allowed them to then be instruments of rolling out infrastructure in the South African context, and that helped historically rolling out of various infrastructure projects. So we're working with our colleagues across the continent to just share experiences and share knowledge in the South African context. I think that the trick that capital markets, especially listed markets, still need to figure out, again, across the continent, is that equity risk within infrastructure. Obviously, the returns can be quite muted in kind of post-construction, in that operating risk. But one of the questions that we've got is when you look at more advanced economies, Europe, the US, you see listed infrastructure funds in taking equity stakes. And in the South African context, at least, we've seen most of those funds are unlisted. And of course, that then limits the amount of capital that can be invested in those funds, because certain mandates will say that they only go into listed instruments. So that's a conundrum that we're looking at and seeing how we can resolve, whether it's listings requirements issues, whether it is just risk appetite, or whether there's structural issues within capital markets? Thanks, Duncan.
Thanks, Sam. Micah, picking up on that, one of the areas that we have seen a lot of appetite for investment, both in South Africa and in other African markets, is in the power sector, independent power producers in particular. In South Africa, I think the figure is probably up to around $15 billion into the renewable energy sector over the last 10 or 11 years. So there must be some kind of appetite there. And there must be that demand that's being driven. Hannah talked about the fact that you have IPPs, mini grids in the Eastern DRC, and people are prepared to pay for them. I know when one of the South African cell phone companies, mobile phone companies, moved into Uganda, the thing that they said was that the available data on per capita consumption or the ability to pay, the ARPUs that they were looking at were so much higher than they thought they would have been, given what the data available said. From your perspective, raising capital in areas like energy, perhaps in water and sanitation, is that the next frontier for independent investment, or do we not have enough of that political entrepreneurship to allow that in a meaningful sense?
Look, I think there's a growing sense of realization with governments on the continents that the monopoly model is failing. And they're starting to realize that, and none more so than in the South African energy market. We've seen quite far-reaching changes to the regulatory landscape, with the licensing requirements being lifted, with unbundling of state-owned entities, and that, of course, creates many opportunities. But from an investment perspective, and when we fund these energy projects and also water, because that definitely is the next frontier, what drives energy investment in Africa is essentially two things. Africa, there's a lot of money for energy in Africa, simply because it is the last frontier for industrialization. It's the last global frontier for industrialization. It's a very commodity, rich continent. So it basically commits it to an energy-intensive growth path. That's the reality. And when you in that kind of economic position, then the value chain then springs from this continent elsewhere. So to unlock that, there's the first motivation. The question now is to say, well, okay, what do we do in terms of funding model? What I've seen with a lot of energy projects that some of our public sector partners refer to us, and it's something so basic, but let me say it. We have a tendency, especially in South Africa, and I've also seen it on the continent, to start with a technical solution, and then we want to retrofit the financial solution on top of that. And this is not our approach here at Kucha. I mean, the first thing that we do is we say that, look, does this make sense from an investment perspective? What kind of financial model would enable it? Where's offtake going to come from? Do we need an aggregator? So, for example, for domestic demand, what you would typically want to do is you would set up aggregator demand and some kind of aggregator. It's a lovely opportunity for local value chain creation and local participation. And you then, and that then becomes a counterparty. You de-risk that counterparty, you underwrite that demand, and now you've got the beginning of an investment case. And it's in that context that you can then start looking in various ways around the catalytic funding for that project, that initial project development funding. Now, as much as there are so many developmental finance institutions that would say to you, look, I would fund 50% of your project development cost at risk, but then I get the mandated lead arranger mandate. And many people go for that, and sometimes it makes sense. But, you also have to look at the whole transaction cost. What are the fees that you're committing to? To what extent do you constrain your optionality framework in terms of how you can structure that deal? So, but when you start with that financial model, and when you start with risk, and normally when you start with that first investment decision, is that commitment mechanism and is that offtake? This is where we start. We start with how we're going, the revenue stream, and then we engineer backwards. then it is very possible to actually get venture finance in, and private sector venture finance. Now, specifically around properties, Guga is also an industrial estate. It's a special economic zone. We're sitting on a good 9,600 hectares, and it's a greenfield site. So the top structure requirements that we've got arising from this SEZ and the 17 African countries that we are assisting in developing similar industrial parks and that sort of thing, we've had significant interest from property funds based all over the world, listed property funds who want to do it. I've just financed a government office complex with a ticket size, not a big deal, about 1.6 billion. But we had no issue, and we literally closed that deal in 2 months with a listed property fund actually coming in as the primary equity holder. But the thing is the questions that could be answered right at the beginning. And the solution was driven. The technical solution follows the financial solution and the investment case is because it worked out. And one of the things that also adds a lot of friction and a lot of cost, and fractions of percentage costs, especially on marginal projects, like, for example, when you're trying to supply water and electricity for domestic households that need to be subsidized and for humanitarian purposes, those fraction percentage points start really mattering in terms of how you financially engineer your project. And you don't want costs to start compounding in. Another thing that we also do, and that is we realize, we develop whole class of projects that are similar projects, because the costs to thoroughly evaluate an investment opportunity, if you're a listed fund or if you're private sector, given the idiosyncrasy and all of that sort of thing, on a project by project basis, doesn't make sense. It doesn't make sense. So what you want to do is you want to develop a whole class of projects with very similar underlying assets, so that the costs can be spread over the class rather than the individual project. And then you've just taken a good 3% out of that financial model, and it makes a huge difference if your revenue stream is going to run over a tenure of 20 to 25 years. So that's the kind of thing that we need to look at. Talking about frontier markets, I'm now busy closing a project in the Central African Republic. Population 5.5 million people. It's a country that's currently in a state of civil war. I'm dealing with the South African banking system on this one. How did we get this through? Yes, there was ECIC insurance involved, but the key thing there is this is where we really started looking at the risk. And what we've done is we've actually repackaged risk, because you also want to say, well, where does this risk arise? So if you're talking about revenue streams, the car currency is actually pegged against the euro. So you don't have that much of currency risk that you need to insure. The issue that you need to insure is where those revenue streams flow to. And if you can relocate, if you can resite that risk into another jurisdiction, you actually have taken quite a bit of the risk out of the process. Also, that unbundling, bundling approach. And all of a sudden it became financeable. There's not a single developmental financial institution involved. It's all private equity. It's all commercial finance, and the project makes sense because we've de-risked it properly and we've built the investment case properly. But we've started with the financial engineering.
That's perfect. Thank you so much. And it's absolutely fascinating example of the Central African Republic, because I know from experience that is an especially difficult market to try and unlock in many respects. We are starting to come towards the end of this session, and I don't want to rush anybody. So what I would like to do is once again offer each of you a couple of minutes just to talk about. We've heard about, I think, some of the issues around unlocking project and project finance on the continent, issues around lack of reliable data, risk perceptions in certain of the markets, the way projects are packaged, and a number of other areas. Going forward, is there a role for technology to overcome this in the delivery of some of those areas? And where in the next 5 to 10 years do we see project finance? If China has started, as Stephen said, to to withdraw slightly from the continent? In a post-COVID environment, will we see other countries either replacing that, or will there be a general withdrawal of finance as countries look towards their own needs and their own populations? I think we're seeing it across the globe, a fairly difficult situation at the moment. So a double header. Can we use technology to demystify, if you like, some of the key issues that have held up investment in infrastructure across the continent? And then where do we go from here? Does the continent have a narrative in terms of the growth of population, of cities, of commodities, and industrialization that will provide those anchors and the basis for infrastructure development? So I think, yeah, if we can address that, Paul, where do you see this going?
So yes, certainly. I mean, from ECIC, when we look at some of the game changer projects we're looking at, such as support universities over and above the water, road, rail, power type of projects. So that in itself is stimulating the intellectual capital as a way to unlock value. We see that as a way forward, because that in itself means that even the technological advancement we see happening all the time will also align with that. And certainly, you know, we have seen with some of the financial solutions that some of the players in the venture capital as well as in the traditional banking market that are coming out all the time means that they will just accelerate, so much so that in the next 10 years, the sources of funding will no longer be just the traditional ones we know, but they will be alongside some of the new ones that also will be challenging ECIC to support, because at the moment, working with the regulatory framework implies that we can only support financial services providers that are licensed by the South African Reserve Bank. So we see a lot of that happening very rapidly, and it just gives us more energy to give more appetite to those game changer projects on the continent. So that's where we see ourselves going.
Perfect. Lungile, from the DBSA's point of view?
Thanks, Duncan. I think I will speak where we see project finance heading. And I think it's very difficult to speak of it in general terms. I think it's easier when you bucket it per sector, and how mature funders have, how comfortable funders have gotten their way around specific sectors, for example. I can give an example here in South Africa, the renewable IPP program. I think when it started, it's a classic example. When it started, the project financing structures there were, it's night and day if you compare it to what it is now. Yes, from a government guarantee and all of that perspective, it's still there, but lenders have gotten comfortable. They no longer require, those stringent covenants that were initially there. They've relaxed quite a number of requirements from a funding perspective, even from a cost of funding perspective. So as the market matures, lenders become more and more comfortable with that sector. So I would like to see more innovative structures being put in place to support infrastructure such as toll roads in the rest of the region. Where projects face huge market risk from a lender perspective, I would like to see an advancement in the way we approach the funding of those projects, and really assist as lenders in terms of putting our heads together and finding a robust structure that mitigates risk but also allows the project to be bankable and fully funded at the end of the day. So really, it's those projects that face a lot of market risk that lenders are sometimes uncomfortable with taking up that risk as a project risk entirely. Thanks.
Thanks, Gile. Stephen, some thoughts from yourself? You're on mute.
So when it comes to technology, I think the area that will make the biggest impact is actually in the fintech space, in driving and promoting the development of a deeper and broader investor base for the supply of the capital for the capital markets. So, it will drive the growth of the sort of buy and hold investors, for example, like insurance companies or pension funds, and sort of the buy and trade investors and private investors in that space. So that will drive the growth of capital provision. I think as we look forward to the future, we have to recognise that we are going to be going through a period of tightening fiscal space and downgrading of a number of countries' credit ratings in the years ahead. And so in order to make projects affordable, credit enhancement is going to be a central part of that, and putting in credit enhancement that takes the risk outside of the country. And this is where the likes of UK Export Finance, the export credit agencies, will be coming into play and be much more involved in externalizing the credit risk of projects in Africa and making them affordable.
Perfect. Thank you very much. Hannah?
Thank you very much. So first of all, I think everybody needs to bear in mind why what we are trying to achieve, or why we are doing what we are trying to do. If you look at DRC, at the end of the day, it's a large country, 100 million people, 50% of the population below like 15 or 20-year-olds. So we have a duty to make sure that we provide these youth with the right level of infrastructure to just enable them to have, an interesting, fulfilling life. And this youth, I agree, is very innovative. African startups have been thriving on the continent in all sectors. So it's very inspiring to see this youth trying to have an impact, live a decent life despite the lack of infrastructure. And now also on a positive note, even in a country like DRC, we have to acknowledge and recognize, as Longile said, that there is an improvement in a number of metrics, and that investors have to take them into account in the way they assess risk and in the way they structure their packaging. So if we look at DRC, we see that the ecosystem has professionalized itself. We have public regulation agencies that are much more effective. You have a professional organization of renewable energy operators, for instance, in the countries, that is very active, that is providing training to energy operators to help them understand how they need to structure their project, how they need to put together data rooms. So all this work is getting done. So from that perspective, we see also DFI starting slowly to come to the dance. And there are two features I would like to highlight. I've been very pleased, and I hope the collaboration will be successful, but to see that the German government has put in place an organization like Get Invest, which is fully funded, so 100% free for energy companies, that is expecting to assist energy companies to put together data rooms, and then those energy companies come back to us, DFIs, with the right structure, with the right information, so that we can motivate their case internally a bit more quickly and a bit more effectively. So this is how to assist in terms of project preparation, as Stephen was saying. And the last point that I would make is that at some point we also need to understand what's the trade-off between impact and commercial returns, and to understand that sometimes in frontier markets, you might have to give up a bit on the returns to make sure that you have an impact. And at Proparco, we are pleased to announce that a few weeks ago, we've decided to put more grants available for projects in what we call fragile countries, which include DRC, and to try to use new tools to make sure that we can actually finance the projects that are submitted to us.
Fabulous. Sam, Your thoughts?
Yeah, thanks, Duncan. So just on the technology side, we with JSE private placements, we went to technology first. So we partnered with a UK fintech called Globacap, and really it's a platform for issuers and companies and projects looking for capital to meet with investors. And we've seen good traction in the last 3 months that we've been live with our first infrastructure project coming on the platform in the last few days. So we're excited to see how technology is becoming pivotal in helping project finance. And we think that even just as Stephen mentioned, that whole fintech value chain has a lot of value to add in infrastructure going forward. I think on the broader kind of future of project finance, just touching on some of the issues that Lungile touched on, even from a renewable energy IPP process that was so successful in South Africa to crowd in billions of dollars of offshore private sector funding. I think there we're seeing a test case in good legislation, proper kind of institutional frameworks coming together and being capacitated, and also standardization around the project. And so, my hope is that the future of infrastructure finance across the continent copies that model of kind of standardization, institutional framework, enabling legislation to crowd in those billions of dollars that we spoke about that are available in the private sector globally to push forward infrastructure in the continent. Thanks.
Great. Thank you, Sam. Micah, the last word is yours.
I think for me, the most market impact that fintech and digitalization of finance will have on the African market, and it's a double-edged sword, because it's going to solve the problem of idiosyncrasy and asymmetry of information. And so on the one hand, when you've got complete line of sight over something, it can either de-risk or, depending on what you see, it could also backfire horribly. And let me give you an example. We spoke earlier around the Chinese model for infrastructure funding. Now, typical to that model is what they do is they finance and they've got a built-in return for rights to resource extraction. So it doesn't crowd the public sector accounts. It doesn't deteriorate the debt path. And it allows an opportunity to actually quantify future revenue streams derived from natural resources and natural resource depletion, which in a funny way can sort of almost improve your public accounts. Now, the benefit of an approach like that is that it offers you the speed and a full range of services in which the infrastructure can be designed, built, financed, and transferred. But you by locking in the natural asset depletion, you avoid the pressures as a government to dissipate resource revenues in recurrent expenditure. But the problem with these things is that those models are often very difficult to evaluate, and they are opaque, and they're very hard to price. And this is where technology can actually play a huge role, because that business model, together with the existing offerings that we've got for the financing of infrastructure on the continent, can actually become a very powerful mechanism. Here's another example. We are going to see a lot of social infrastructure disaggregate. And let's use the simple example of rooftop solar. And we don't have a humanitarian infrastructure finance offering that is suitable for very small scale infrastructure projects. So, for example, distributed installation of 5 megawatts. But that's the kind of stuff that starts moving the dial on poverty, that starts unlocking all sorts of things like that. And when you start disintermediating project finance, which you could do through technology, you start opening up that market and massively enhance the developmental impact of what you can get out of infrastructure. A final point to that, depending on how you structure the finance and depending on how you use your technology, you can also solve another problem in infrastructure. And that problem is the differential in terms of cost of finance between public and private investors in infrastructure, and the differential in the social returns. So the social returns for infrastructure in Africa is quite high. Very difficult to capture if you're a private funder of that infrastructure because of all the externalities and the fact that infrastructure is dependent on, one infrastructure project is dependent on another. So you can't look at it in isolation. And this is where we need to achieve a greater integration. But through disintermediation, through having complete line of sight, you could actually start capturing some of those externalities in your financial design, which compensates for the cost differential between private and public finances. And then, of course, we can blend and we can do all sorts of very other interesting things with technology. But the point that I want to make here is that technology is not the solution. It is something that can enable a solution and something that can allow you to implement solutions that we currently can't do on our current technology platform.
Micah, thanks very much. I think your point about technology as an enabler is well taken. Technology obviously is marching apace, and so things like the rooftop solar becomes an option, particularly in rural areas, for either off-grid or mini-grid solutions as well, if we stick to power. And I think particularly in the delivery of social infrastructure, it does become more of an option to look at smaller solutions going forward, perhaps not on large infrastructure like rail or highways or ports or airports, but certainly at that social infrastructure level. And I think more and more work is being done around that. The point that Hannah made a lot earlier about the fact that in areas of the Eastern DRC, where the assumption perhaps was that people would not be able to pay for electricity or for energy, and in fact they are, just underlies the fact that we need to have something of a reset in our assumptions around project finance across the region. We've unfortunately come to the end of our slot. It's been fascinating listening to all of you and learning from you around how the mistakes we've made in the past around packaging projects and delivering them, some of the solutions going forward, and also just the appetites and where they sit within the region, and whether it's on a sectoral level, a country level, or any other level. So I'd like to thank all of you for being a part of this panel today. I think it adds richly to the overall Infrastructure Africa conference, and we look forward to taking this chat a lot further than a panel discussion, and making sure that it hits the ground in the future and in the not too distant future, so that we're all able to see this beautiful continent of ours unlocking its real potential. Thank you very much, everybody, for joining us. And from my side, thank you very much for being with us. Goodbye. Cheers.